There is a strange paradox in today's economy. You might have noticed it yourself. Earning more money right now somehow feels like you're actually holding on to less of it. And it isn't about poor planning or a lack of effort on your part. It's actually tied to a massive structural shift in how consumer markets operate as we sit here in 2026. In this explainer, we are going to dismantle the hidden mechanics silently draining modern wealth. We'll look at how spending decisions that made perfect sense a decade ago have quietly morphed into perfectly engineered financial traps. Let's get into the capital lens, the hidden mechanics of modern wealth trains.
So why exactly does making more money suddenly feel like making less? To understand this, we have to recognize that the financial reality of 2026 is vastly different from just 10 years ago. What we are experiencing right now is the direct fallout from the end of a very specific economic era and the beginning of a new one defined by high inflation and shrinkflation, where companies are giving us less product for the exact same price. The rules of the game have completely changed, and the consumer habits we built back then just do not deliver the value they used to. To get to the root of this shift, we need to rewind a bit to the venture capital subsidy era, right around 2014 to 2016. During that window, tech startups essentially subsidized consumer costs to rapidly acquire millions of users and build market monopolies. Investment firms were pumping billions of dollars into these companies to artificially lower the cost of a lifestyle we didn't even know we couldn't actually afford. They got us hooked on cheap luxury before quietly pivoting to a policy of growth at any cost, systematically pulling back those perks.
Which brings us to our first major wealth trap, the convenience premium, subsidies to surcharges.
Let's apply this to something most of us have right on our phones, food delivery apps like DoorDash and Uber Eats. What used to be a cheap convenience has turned into one of the worst everyday financial decisions you can make. The scale of this financial distortion becomes painfully clear if we just look at a Chipotle burrito. In-store, the base price is $15.35, but the second you order that exact same burrito through an app, the base price is inflated, and then you get hit with a service fee, a bag fee, taxes, and a tip. Suddenly, your $15 lunch spikes to nearly $29 if you aren't paying for a monthly subscription. We are talking about a 30 to 40% markup here, a massive margin just swallowed whole by a digital middleman.
And this price inflation isn't just isolated to delivery. The 2026 fast food reality is that a double quarter-pounder meal at McDonald's will run you $14. The traditional price gap that used to make fast food a cheap alternative to casual dining has completely evaporated. The high-value proposition is mostly gone, aside from a few weird anomalies out there, like Costco's $1.50 hot dog, which honestly just serves as the exception that proves this new rule.
Now, let's look at another systemic wealth drain. Financing depreciating assets, the math of value destruction.
$1,100,000. That staggering number is the hidden opportunity cost of financing a new car today. Right now in the US, the average monthly payment for a new vehicle is hovering around $750. If you took that exact monthly payment and invested it into a low-cost S&P 500 index fund for 30 years instead, your potential return sits right around that $1.1 million mark. That is the true, quiet price a consumer pays just for that new car smell.
And the math gets absolutely brutal when you dissect the structure of a modern auto loan. Step 1. You buy a new car for an average of $50,000 at a 7% interest rate over 72 months. Step 2. You end up paying over $11,000 in interest alone. And step 3. By the end of that loan, the underlying asset has depreciated to just $25,000. This financial structure leaves consumers completely underwater, often owing more than the car is actually worth in those early years. A much more capital-preserving move is buying a 3 to 5-year-old vehicle for cash at a 30 to 40% discount.
This strategy of capital extraction extends right into our pockets through what we can call the engineered hardware cycle. Just look at the yearly iPhone upgrade. Since 2007, Apple has leaned on annual updates that create this powerful illusion that you absolutely need to upgrade. But today, the actual technological differences between consecutive generations are incredibly marginal. Wealthy individuals, people who truly understand capital preservation, protect their money by waiting 3 to 4 years to upgrade. This lets them experience a genuine technological leap without falling into an expensive, recurring marketing trap.
Moving from tech hardware to the financial illusions sold alongside it, we have to talk about extended warranties. Retailers absolutely rely on these as one of their highest margin products. They are engineered to monetize a buyer's anxiety.
But what a lot of people don't realize is that premium credit cards like those from Chase or Amex already provide automatic, free extensions on manufacturer warranties. So buying an extended warranty at the register often means you're just paying for coverage you literally already have, not to mention all the manufacturer exclusions that make these policies notoriously useless when you actually need them.
This naturally brings us to some even deeper, more entrenched financial myths. Disrupting financial illusions, Wall Street and real estate.
Let's start with Wall Street and actively managed mutual funds. The prevailing idea is that paying a professional manager guarantees you'll beat the market, but the data tells a completely different story. Looking at mutual fund performance from 2005 to 2025, S&P Global data shows that a massive 85 to 90% of actively managed funds actually failed to outperform their benchmark index, and yet they continue charging premium expense ratios, typically between 0.75 and 1.5% year after year.
The silent destruction caused by these fees becomes undeniably clear over time. Let's say you have a 30-year outcome on a $500,000 investment. If you park that in a passive, low-cost ETF like VOO with a tiny 0.03% fee, assuming standard market growth, you'd end up with roughly $5 million. But if you put that same money into an active mutual fund charging a 1% fee, you end up with just $3.8 million. That is $1.2 million of potential wealth completely vaporized, not because of a market crash, but simply because of fees.
From Wall Street, we pivot to real estate, where we run straight into the ultimate American dream, the starter home. Back in 2016, mortgage rates made owning pretty comparable to renting. But today, with rates sitting around 6.5% to 7%, the math has flipped. As LendingTree points out, U.S. homeowners with a mortgage now pay 36.9% more a month than renters do in major metros. To really illustrate this, let's look at a starter home in the Bay Area. To own a modest house there, you were looking at about $8,500 a month after taxes and insurance. Meanwhile, renting a comparable home in that same neighborhood costs about $5,000 a month. That means you are paying a $3,500 monthly premium simply for the privilege of ownership. That massive difference is capital that could be compounding in the market rather than being frozen inside drywall.
Finally, we arrive at our last phenomenon, the hidden status tax, emotional spending in 2026.
$7 trillion. That is the size of the global wellness industry right now. What used to be a set of simple, healthy practices has morphed into an industry expertly designed to monetize our anxiety. We are talking about $25 smoothies and $300 yoga sets. This industry is increasingly selling extremely expensive, illusionary shortcuts to basic health, things that can generally be achieved for free through walking, decent sleep, and eating whole foods.
So, how do we navigate this? The most clinical framework for evaluating these kinds of status purchases, whether it's $2,000 bottle service or designer goods, is to ask yourself one simple question. Would you still buy this item if no one else could see it? If the answer is no, you aren't buying utility, you are buying a social signal. Separating genuine utility from social signaling is the absolute dividing line between those who actually build wealth and those who just look rich.
And a perfect example of this unchecked premium is live entertainment. We've watched concert tickets jump from a standard $50 outing back in 2015 through the COVID pause in 2021, skyrocketing during the 2023 Taylor Swift demand surge, to land at a staggering $275 or more in 2026. This isn't just inflation. A combination of pent-up demand, megatours, and the unchecked monopolistic fees from platforms like Ticketmaster have turned a simple Friday night out into a heavy financial burden.
Ultimately, understanding these economic shifts isn't about forced austerity or never spending money. It is about being highly strategic with your capital. It comes down to asking yourself, how much of your future wealth are you trading for today's engineered convenience? Critically evaluating your 2026 budget and redirecting your capital away from these modern consumer traps and into compounding assets is the only proven strategy to protect your wealth in this new financial reality.